Emily, thank you as usual. It's always a pleasure to see you and, of course, working with you. Angela, my partner in crime, good to see you again today after multiple calls this afternoon. Anyway, everybody, welcome to week 5 of OnRamp and our 4th workshop. We are halfway through and we are excited about the progress and the things that we're learning, and that is what we're learning from you, what we're hearing, what you're sharing, and hopefully you're gaining from what it is insights and information and content we're providing to you. So tonight's workshop, as Emily said, is really about business and legal structure. I am proud to say that we have a dynamic facilitator tonight, Eamon Gallagher, who probably doesn't need introductions to many of you, but those who you don't know, is an amazing attorney that specializes in working with startups and founders and small business, especially out of the Drexel Law Clinic, as well as IC 3401 here at the Science Center. He is the go-to guy for us in supporting small business initiatives around legal and business matters. So you'll hear from Eamon in a minute. He'll give you a little bit more about his background. Just want to cover some housekeeping before we get into our poll for tonight. Angela, we have our poll ready for tonight, right? We got our poll ready for tonight. And thank everybody also too for being responsive to that. That data is going to be very helpful to help us inform how we make this operation, this program much better. Just a couple things. We know we're getting many inquiries about the pitch competition. Good news, we have a draft program that's currently being run through approval at the Science Center. So hopefully next week we'll be able to announce the guidelines and launch the submission requirements, which will be online for you to apply. As we shared earlier from the very beginning, participation required you to attend at least 6 workshops. So if you've been involved since the very beginning, that's not going to be a problem. And then from there, we'll announce the other criteria going forward after we get the sign off on it and be sharing more about that next week. In addition to that, don't forget that Startup Roundtable is immediately following. And Mr. Gallagher, are you going to still be doing that tonight also?
Oh yeah, it's a normal Thursday.
Oh, you got a long day. I guess I'm going to owe you a beer, huh?
We'll talk next time we're in. You can pick up the tab next time we're in person.
You got it. You got it. That's a promise. So Eamon and Aaron facilitate Startup Roundtable, which is an amazing opportunity for you to learn more about different programs and how to really build your venture, as well as get support and information about other initiatives the Science Center operate. And then finally, our poll for tonight, Angela, is what? And we're getting great participation. So we're going to look to have everybody respond before tonight is over. What are your business startup priorities for the next 12 months? What are your business startup priorities for the next 12 months? Product development, sales growth, improving leadership, management skills, improving technical capacity of your venture, hiring additional talent, expanding new markets, raising capital, and others. So please complete the poll. So that data is very important as we move forward to look how we make OnRamp the best program it can be here in Philadelphia. So without any further ado or any burning questions for me at this time, something in the chat. It is my pleasure to introduce you to a extremely talented, gifted, knowledgeable individual that I've known for quite a few years now. I've been working with on a number of projects. Not only is he a seasoned attorney, but he has a very diverse background, but he has really created, and he's passionate about really where he could probably be with a major law firm. He is passionate about working with startups and founders. And so I think we have a unique opportunity to learn some interesting things from him tonight. And as usual, our sessions are very interactive. You can drop questions in the chat. You can raise your hands through the prompts on the Zoom screen. But without any further ado, it is my pleasure for you to introduce tonight's facilitator for our workshop, Eamon Gallagher.
Thanks, Tom.
Thanks
for having me. It's always good to be in the friendly confines of Venture Cafe And it's great to see so many faces. Some of you know very well, some of you I know and recognize a little bit. Some of you I've seen your names over the past OnRamp presentations. We have award winners in the audience. I think Nefer Terry was 40 under 40 award winner recently, recognized by Technically Philly, along with Tom and Aaron Starasta, for helping to keep people connected through the pandemic. So it's great to see such a broad cross-section of the community here. To briefly dive into my background, I am not a native Philadelphian, but the entirety of my professional career has been spent here. I've been through a few careers now. First as a technical recruiter, helping identify and hire talent for companies growing from venture capital raises to private equity raises to acquiring other companies and building out home offices in this region. Then went back to law school with the idea that I'd be able to work with folks like all of you, help get you set up and build and grow businesses here in this region. My parents are both social workers. My grandparents are social workers and educators. So I never went to law school with the idea that I'd become a partner at a big firm. That was never interesting to me. It was about helping people build more better things that would create more opportunities for people. And what better place to help build the startup ecosystem in Philadelphia, top 10 city nationally, has a lot of challenges that to me translates to a lot of potential that's just waiting to be tapped into and grown. And so my goal for this evening is really to just give you a quick overview of the basics that you need to get in place from a legal perspective to help set up a foundation to go out and grow your company. The assumptions that I'm making for a lot of this are, one, you may or may not have a legal entity yet, so you're going through that process. Two, you're thinking through the framework of how to set up that entity in order to generally compensate people with equity. So you're going to have partners, you're going to have maybe employees, you're going to have other people that are going to get a piece of the company based on their contributions to the company. And how do you protect yourself and create a system that allows the company to grow and thrive and keep everybody incentivized while protecting yourself as the founder. And three, setting that up in a way that if you do get to a point where you're looking to go out and raise capital, whether that's from investors, be they venture capitalists, be they angel investors, or potentially bank loans, that it's set up and you've thought through the right things and the right framework in order to be set up to do that. And so happy to take questions at any time. Just stop me, put something in the chat, I'll keep an eye on it. But unless there's anything immediately, I want to start off with a question. How many of you have not yet started a legal entity for whatever the project is that you're working on? You can post in the chat, you can virtually raise your hand with things. If you're driving, please don't, keep your eyes on the road. Never Terry. Let's see. Got a couple of hands raised. So I don't know if other people just aren't currently able to engage, but let me start sharing my screen here, and we will we'll start to go down this pathway here. So, all right. Legal framework for startups. How do you build a legal foundation? So again, my name is Eamon Gallagher. I am the director of the Entrepreneurial Law Clinic at Drexel Law School, which provides free legal services to startups. I do not currently have my own independent practice. I spend my days at 3401 Market Street running an incubator, a couple of accelerators, a pilot venture fund for the University Science Center. And so this is what I do all day long, which is to say, help entrepreneurs get set up and grow, to do that from a nonprofit perspective with a long-term goal of economic development and having more successful businesses here in Philadelphia. So first of all, why do you create a legal entity? What is the specific reason that you would want to go through that process? You're going to have to pay a few $100s, less than $1,000, depending on what you're doing and where you're doing it. It could cost some more or less. But what is it that would cause you to say, hey, I really need to figure out what's going on, and I need to start to worry about protecting myself, family, whatever it is, right? And so usually there are two primary reasons. One, personal liability protection. Whatever you're doing in your business, you want to stay in your business, right? That's part of the American system of law and the American system of business is, unless you're doing something really egregious, you want to limit any potential losses to whatever you've created as a part of that entity. The second thing, which I think people think about less, is you're really starting to acquire a lot of either assets or liabilities. So what does that mean? You could be taking out a loan. You could be starting to sign contracts with customers. You could be creating a business partnership, and you want to keep everything in one place. Without a legal entity, what you have is called a common law partnership, which means that if your partner signs something saying you're going to pay a few $1,000s and then they take a hike, you're on the hook for that, right? Because you're jointly and severably liable for any liabilities that come out of that, right? So it could be customer lists, it could be any number of things. You have products, you have other things that you're working on. You have either assets or liabilities, and it's time to do that, right? Why wouldn't you yet create a legal entity? I don't think it usually makes sense to go through the process of creating a legal entity and paying the money to create a legal entity, or for that matter, doing a whole lot else, unless you're starting to really, again, aggregate assets. It starts to make sense, and there's a reason to pay money out, right? Don't pay money out just to pay money out. You shouldn't have that luxury. You shouldn't approach it in that way, right? You should be thinking logically about what your growth looks like and why you would want to do that. And so you're starting to write checks, you're starting to pay people, you're starting to get customers, you're doing other things. Now it's time to create that entity. So again, when do you create that entity? You're at a point where it makes sense to pay a few $100s out of your pocket to do that, right? And again, I think a lot of people can start to fool themselves when they're building their business with having this long checklist of things that maybe need to get done, but maybe don't need to get done, but aren't related to building your business. So you should be going through all the other sessions that we've had already as a part of OnRamp. You should be focusing on lean foundations and testing out ideas and doing other things, but focus on having a product that people want to pay for and building something that solves a problem in the market. Don't focus on finding an accountant and finding an attorney and creating a legal entity and doing all of these other things that you can get caught up in a list of things that you're checking off, but really aren't helping you build a business. So you're at that point, you're going to move forward, you're going to create that entity. Now, what are your considerations? So there are basically 4 choices to make here. One, which state are you going to incorporate in, or which state are you going to form that entity? I know from past sessions, we've had people from Miami, we've had people from St. Louis, we've had people from Delaware, New Jersey, Philadelphia, other places in Pennsylvania, right? So you basically have 2 options in terms of where. You have where you are located, whatever state you're located in, or you have Delaware. Don't try to get too cute about it. I've seen people that are like, oh, well, I read this thing about Nevada or Montana. If you're in Montana, that's great. If you're not in Montana, if you're not in Nevada, don't overcomplicate this. Your choice is where you are or Delaware. Why do Delaware? So Delaware, you're going to have to pay a couple extra $100 a year. You're going to have to pay for what's called a registered agent, which is your physical presence. The easiest way to think about this is when you see, a 60 Minutes episode or something like that, and they cut to this office building and they say over 300,000 companies claim to be based here, right? What that is a registered agent's office, right? It's a perfectly legal process. That person is literally there to be, from a legal perspective, your physical presence in that state that allows you to claim that as your home base. And it is there basically literally in case you get sued to forward that letter to you. That's effectively their function. So you can pay, as low as about $100 a year. You can pay for, platinum plated registered agent services. Their function is the same, right? They're forwarding a letter to you if you're getting sued in Delaware, right? So That's effectively what you're doing. It also, like in comparison to Pennsylvania, it might cost maybe $100, $150 more to form that entity. And so why would you make that calculation? And I think there are really two primary reasons that you might want to go with Delaware over the home state. The first is a bad reason, which is it's kind of what everybody does. The second is a better reason, which is it's a better insurance policy, right? If you go back to why you're forming this legal entity, it's to protect you and your personal assets. If you draw that out, right, it's because you're getting sued, right? That's when your stuff is at risk. And so Delaware has appointed judiciary that focus specifically on business and corporate law. And all they do all day long is deal with these types of issues. So that means two things. One, when you first go into court, there's a much higher probability that those particular issues are going to be resolved correctly the first time. That means you're in litigation less time. That means there are fewer appeals. That means less money on the back end, right? So it's that better insurance policy. It's going to cover more on the back end. The other reason is that people are really familiar with it because everybody does it, right? So if you're going to go out and raise from a venture capital firm, I have worked on deals where people are getting invested in as PA, LLCs or corporation, as Virginia, LLCs or corporations, Georgia, Maryland, Connecticut. They will invest. It's usually not a reason that they won't invest, but there's a certain level of comfort there. And so what's going to happen when you're going through an investment is they're basically setting up a checklist of things. Have they done this? Have they done this? Have they done this? Theoretically, it could be a red flag or part of a red flag if they don't see something in Delaware, but it's a surmountable issue, right? Nobody's going to say, I am so into this company. These people are changing the world, but they have a Maryland LLC, so I guess we really can't do that, right? You can change the world from anywhere. So that's why potentially you might want to be in Delaware. The second choice is really corporation or an LLC, right? And I think most people think of corporation and they think taxed as a corporation and they think double taxation. I think most people see LLC and they think pass-through entity. Those things can be true, but don't necessarily need to be true. In other words, for a corporation, yes, you can be taxed twice, but that requires that you basically are giving dividends or payouts to shareholders and that you as a CEO are making more than is what's considered reasonable compensation, quote unquote, by the tax authorities. And if you've seen any of the CEO compensation packages in Bloomberg and New York Times and Washington Post, you can get paid a heck of a lot of money before it starts to be considered unreasonable compensation. So what will happen is if you're not using up the money on the business and it shows a profit at the end of the year, yes, theoretically you could get taxed there. You would also get taxed for any money that you pay yourself as salary as normal salary. There are lots of ways that you can minimize those tax consequences with a good accountant, right? And so at that point, it's time to check that one off your list. You need to go out and find that good accountant when you're in danger of showing profits maybe at the end of the year. From an LLC perspective, LLC is most often set up as a pass-through entity, but it doesn't need to be, right? And so really the way that I think about the difference is a corporation has specific corporate formalities that you need to adhere to. You need to have a separate bank account. You need to have on paper somebody that's designated as the treasurer, the secretary, and the president. You need to have board meetings every so often. You need to have board minutes that adhere to those things, right? You're gonna have bylaws that dictate all of these things. From an LLC perspective, usually it's set up as a much more lenient, forgiving type of entity. That doesn't mean that you can no longer, you don't have to keep the accounting records of what's going on, but it means that you maybe don't need to absolutely adhere to all of those things or risk allowing that corporate veil that somebody referred to as being breached, and therefore they're able to get through to your personal assets. And so LLCs are a lot more flexible. They're a little bit more informal. For most of those things that are kind of good practices for corporations or requirements for corporations, you should probably be thinking about doing those things anyway, right? You should have board minutes. If I'm setting something up for you, you're probably going to have a board of managers instead of a board of directors for the LLC versus the corporation, right? So it's going to be set up in an analogous way, but there's a lot of flexibility to do that in different ways. Somebody asked about an S Corp. Can't ever recommend an S Corp for a lot of reasons. There are all kinds of limitations that make it really difficult to use an S Corp. And so, excuse me, some of the examples limited to 100 shareholders. If you're going to go out and do, for example, crowdfunding, or you're going to raise from angel investors, or you're going to have a lot of people that you're going to incentivize with equity because you're going to become the next Amazon and the next Jeff Bezos, right? That's going to get over limited really quickly, right? You're going to extend beyond that 100 shareholders. Those 100 shareholders must be US citizens or green card holders. Generally, they cannot be other companies, right? So you're going to run into issues as soon as you try to raise money from a VC or somebody else. You know, again, if you have an immigrant founder that maybe doesn't have their green card, is on some type of other visa, they can't have equity in an S Corp. And so there are just a lot of limitations. If you want to have a pass-through entity, you go through the LLC process, you set it up as a pass-through, it'll have all the advantages, and then a lot more. So somebody else asked, couldn't you set up a second corporation in Delaware and merge the existing PA Corp? So Benjamin, I'm assuming you're asking from the perspective of you already have one entity and then you want to set up potentially another entity to convert to a corporation. Is that kind of what you're thinking about?
More along the lines of like, if investors are really insistent about Delaware, but you've already got operations as a PA Corp, couldn't you create a parent corporation in Delaware to appease potential investors and just merge it?
Yeah, so more likely if you're, for example, you're a PA LLC and the VC, which we can get into in a little bit, VC is going to require you basically to become a corporation. There are some counter examples there. Angel investors sometimes like to see LLCs as pass-through because they can take some of those losses. Again, if you're anywhere in this kind of four-box matrix of decisions, I think you're going to be in good shape. But basically what would happen is you'd probably convert to a corporation and move that corporation's headquarters from Pennsylvania to Delaware. But again, you know, VCs invest in PA corporations and Delaware corporations, right? Okay. So they may have a preference for that, and that may get rolled into the deal. In other words, you're getting, you know, $500,000 from a VC, right? They'll just pay as a part of that process to convert you over when they're making the investment at the same time. So usually you don't have to worry about that conversion before there's money to do it, right? Going back to the earlier point. So there's money coming in, that check is going to come straight in. It's going to be minus the legal fees, or the legal fees are going to go straight out the other side. And it's a nominal fee effectively to go from an LLC to a corporation, or to go from a different state to Delaware as a part of that process. For a DBA doesn't provide any liability protection, right? So you have to have a separate legal entity that's going to protect you. If, for example, you have a company that is, I'll just look at something on my desk, minimalism, right? Minimalism LLC, but your product is called Shutterfly, right? You could potentially, as minimalism LLC, have a Shutterfly DBA, right? And so there are lots of other ways to do that, but a DBA on its own is not going to provide you with liability protection. So you still have to go through the process of creating that entity to protect yourself. So getting back on track here for a second, you can be an LLC, you can be a corporation. LLC is a little bit more flexibility. It generally is set up as a pass-through, but it doesn't necessarily need to be. And then there's another wrinkle, which is becoming much more popular, called a benefit corporation, or a B Corp, which is a separate legal entity. From a practical perspective, you can just consider that a corporation. Literally what a B Corp is it is a corporation where you specifically enumerate, in addition to return, you know, capital or maximizing profits for shareholders, we are going to take these things into consideration when we're making corporate decisions. That's the only thing that it does, right? So you have to know what those exceptions are going to be. In other words, what are the things you're going to be thinking about? For Patagonia, that's the supply, you know, sustainable supply chain. That's you know, sustainable sourcing. That's certain labor requirements and making sure that people are paid living wages, right? Those types of things. You can lump in those things. You can come up with your own things. It's pretty flexible. The catch is that you have to report on that back to the state where you're incorporated as a B Corp every couple of years. So you have to create a formal report that says, I am actually using this in the practice of my business, and here's how it's affected some of the decisions that we've made. Here's the use case on what that looks like. And yeah, check out the event on B Corporations here at Venture Cafe on June 10th. So Joelle, just quickly, DBA for your LLC. Most of these things, right, from a practical perspective, the way that you're creating them, it is a one sheet of paper. It's filed with, you know, if you're in Pennsylvania, it's the Department of Corporations. If you're in Delaware, it's also the Department of Corporations. If you're in New Jersey, it's the Secretary of State, right? So you're filing this one sheet of paper, and the one sheet of paper in the one instance might be to create that LLC or corporation, right? It would be a certificate of formation usually, or articles of formation, or for a corporation, it'd be a certificate of incorporation, something like that. And so you just file an additional sheet that says, I will also be, as you know, myself, Joelle, I will be doing business as, you know, Minimalism LLC, even if you don't have an LLC, right? Interesting wrinkle. Or I have an LLC, it's Minimum LLC, we're going to be doing business as Shutterfly. So it's just affecting how you're filling in those blanks when you're filing that sheet of paper with the particular state. Can you set up a nonprofit to take in grants and have a for-profit biz serve as the sole technology and marketing contractor? In other words, can you have a nonprofit umbrella and then have a wholly owned for-profit subsidiary? The answer is yes, absolutely. In fact, the Science Center has one of those. Exactly, it's called Research Park Incorporated. It runs the real estate operations that the Science Center is involved with. All of those profits go back to the nonprofit to help offset those expenses and pay for programs like the ones that I run on a regular basis. So you can also do that. It's not an issue. There are different ways that you have to think about whether you're using nonprofit assets, however, in the for-profit, particularly if anybody other than nonprofit is getting some of those profits. So it can get pretty complex pretty quick. And again, for more complex questions, happy to set up time and chat offline if there's really a specific use case. This tends to kind of evolve into, my friend has a situation, we start talking about some really specific things. So what I'll do here is, again, this is the four-side matrix. The only thing to know here is if you're in one of these four squares, unless there's a really weird situation, you're probably fine. You're not, you know, I'm not going to tell you you're crazy for setting something else up. If you come back and say, I heard this thing about Nevada and tax, and you're based in, you know, St. Louis, then we might have a conversation. So moving on. So what else do you need to worry about, right? What are the other things? You've got now your legal entity. And so what are the other things that you now have to do in order to get this thing set up, in order to be scalable, in order to be attractive to investors, or to go back to something else I mentioned earlier, to not get kicked out based on, you know, due diligence process, right? So there are a couple of things to consider. First is intellectual property assignment. So intellectual property assignment is really, really important. I think when most people hear intellectual property, they think of patents, right? That's the first thing they think of. But there are really about four categories of intellectual property. There is certainly patents. There are also trade secrets, right? The secret formula to Coke is, or the Colonel's, you know, recipe for KFC, right? Those are two primary examples of things that are kept under vaults, lock and key, specifically to keep them a trade secret. Patent, right? The whole exchange, or the thing you're doing with a patent is you're saying, I am explicitly going to tell everybody how to do this, but if they're going to use it during the life of the patent, they have to pay me a licensing fee or a royalty fee or something else like that, right? So you're saying, I will contribute to the public discourse by disclosing this super secret, awesome invention, and then I'm going to have the right to charge people for usage of that invention over the life of the patent. The other two things that I think people think less about are copyright, right? And copyright, Dave, you know all about copyright being a photographer, right? It's something fixed in a tangible medium. But if you start to unwind that a little bit, it can be really a whole bunch of different things, right? It can be a specific recording of music or a specific performance. It can be the dance steps up to a dance routine that you write down on a piece of paper. It could be the text of, you know, a book or a poem or a, you know, copy on your website, right? Those are all copyrightable things, right? The other thing is trademark, right? And so the way that I think about trademark is not necessarily protecting a particular inventor. I think about protecting the consumer, right? And so when somebody goes and buys Coca-Cola and you get that red can and it's got Coke's, you know, fancy script writing on it, right? You know, as a consumer buying that cola with Coca-Cola on the side, that you are getting a Coke certified product that is exactly the same quality that you've come to expect from Coca-Cola, right? So you are being protected as a consumer. And again, where this comes up, you see this a lot with fake handbags is a big one, right? Or other fake retail or apparel type issues, right? So there are a bunch of different flavors of intellectual property. The reason we're talking about it now is if you're going to get this thing set up appropriately, everything that you're contributing to this company, regardless of whether it's trade secret, patent, potentially patentable, copyright, trademark, it's all got to get into this legal entity, right? And so you have to craft an agreement that says, yes, if I'm doing it for the benefit of Minimalism LLC and it's related to our specific business, then it's winding up here, right? You don't want all the intellectual property that any given person is doing. You don't want people's wedding photos or, you know, other things that they're doing in their spare time. You just want the things related to the business, but you want them to get into the company because those will become company assets, right? You're paying them, compensating them for their work, and the exchange is that you then get that intellectual property and it goes to the benefit of the business. So that's kind of intellectual property that's going on. Yeah, to Zave's point, Zave's saying copyrights have become softer and softer all the time, hard to enforce. I think it depends on a lot of those things. I mean, certainly some of these more recent art cases in particular with derivative arts have, you know, in some ways have eroded that. There was a recent case in computer software with Google and Java, where they basically built Android on the code base of Java, but then added a bunch of other stuff. And Java came in and sued and said, you built this on Java, you owe us copyright money. And the court determined that it was substantially different enough that those things weren't required. But, you know, both sides lost millions of dollars, tens of millions of dollars in legal fees over, you know, 5-10 year period litigating that. So maybe the lesson is just stay out of court. I don't know. But an important flip side of that, right? If you're accumulating intellectual property, if you're getting a patent, right, that is both an asset and a liability. And I don't think a lot of people think about that liability, right? If you're going to hold on to that particular intellectual property, you have to be able to pay to enforce it. And so if you're Coca-Cola and somebody else comes out with a red can and calls it, you know, Coda-Cola, and it looks a heck of a lot the same and people are buying it, you have to be able to sue them to make them stop selling those cans that are going to confuse consumers, right? If you have a patent and it gets issued and it is now your asset, right? And somebody comes along and infringes on that, well, guess what? You have to sue them to stop them from using it or to force them to pay you, right? And so I think a lot of people think, oh my God, it's going to cost like $5,000, $7,000, $10,000 to get this patent, and then I'm done. But that may not be true, right? And so you just have to. That's not to say you shouldn't pursue a patent, and there are definitely things where you should absolutely consider a patent, and you should talk to a patent attorney about that, of which I am not one. But you definitely have to think about, okay, how do we protect this thing if we're able to go through the process and get it done, right? The second thing is, you know, should there be, so Brandy asked, how about trademarking, right? So you can basically file 3 different ways. You can file as a patent with the USPTO, you can file for a copyright, you can file for a trademark. An interesting wrinkle is that you actually, when you start using a particular trade name or name of the company, you actually have what's called common law trademark, which is a weird thing, but what it basically means is that you have some level of protection in the geographic areas where you are, right? So again, if you roll it out, you can show that you rolled it out and then somebody else came out and started using it later, particularly if you can show that they started using it as a way to confuse your brand with their brand, you can sue to stop them. The reason that you actually file is that it creates what's called statutory damages, which means there's automatically money on the line per the copyright or trademark statute. And what that means is you're going to be a heck of a lot more likely to get an attorney to take that case because there's automatically money on the line, right? It's not just paying out of pocket for attorney's fees. Most attorneys that are in litigation are looking for a share of the winnings, right? That's more important to them than that hourly rate. And so having statutory fees is a great tool to do that. And so let's say you start using Minimalism LLC and Shutterfly, and you roll it out in Philadelphia, but you're selling online, and so maybe you're theoretically national. And then 6 months later, somebody shows up and tries to start squatting on your stuff. Then you might go through the process of, for example, filing for the trademark, but you got to file before you file that lawsuit, if that makes sense. So there are a couple of different ways to do that in an efficient way. I think there are a lot of different ways to do that effectively and efficiently. But again, basically you're imbuing your brand with value, right? And in fact, when you're thinking about trademark, there are different gradations. So if you're doing something that's just describing what you're doing, then there's actually less protection there. So if you're going to do an ice cream business and you call it ice cream, there's going to be basically no trademarkable value there because it's ice cream, right? It already exists. It's out there, right? If you call it XYZ ice cream, right, that might be a heck of a lot more protecting because it's gibberish, right? That's why Google exists. It was gibberish before Google existed. Didn't have a particular brand name attached to it. And that can go full circle also, right? So Kleenex is a great example, right? Kleenex is a brand name, but it's become so common that they're at risk of losing trademark protection because people don't call it a tissue anymore. They call it a Kleenex, right? Same with Band-Aid, same with aspirin, and actually going, again, kind of wheels within wheels, to Google something using it as a verb is actually putting Google's trademark at risk for their brand. So there's a lot of different stuff to think about there. But until you've got kind of a brand name built up, you want to check ahead of time and make sure that nobody else is using it as far as you can tell. But you may delay paying that few $100s to register until a later time when you've validated it and you have money coming in that'll start to help you cover those things. Typical cost for a trademark, if you're dealing with a trademark attorney, then you'll usually have to pay for some kind of like trademark search, or if you're doing a patent, you might have to pay for a patent search. And then they'll put together basically a plan of attack, a strategy for you. The actual filing fees are usually a few $100s with the USPTO for a patent. It can be a lot more than that for a few $100s for a trademark. It's a little bit more than that for a patent. There's also usually more legal time involved. There are also lots of pro bono resources that are available, particularly if you'd call yourself in the creative economy. So there's a group called Philadelphia Volunteer Lawyers for the Arts that's here and will help people file for their trademarks, copyrights. They'll help you file with patent from a pro bono perspective or a reduced cost perspective. There's also, if you're in Philadelphia County, there's a program called LawWorks, LAWWORKS. That's a part of Philly VIP that will also take on pro bono classes and do different things as well. So really, so going on here, right? So next level of protection, non-compete, non-solicitation, those are things that you may want to do. You have to think through it philosophically. So non-compete is basically you leave our company that we created together. You can't go out and immediately start a different company that's doing the same business, right? When I'm drafting these things for clients, the first thing that I hear most often is, well, non-competes aren't enforceable anyway, right? Well, no, you're going to work with an attorney specifically to try to draft that in a way that is most enforceable, right? So that varies based off of, again, the state that you're based out of. California, for example, says they have no non-competes. If you call it a non-compete, it won't be enforceable, but there are other ways to get at that. And basically, there are going to be three parameters to that. It's going to be the geography, basically where you're looking to prevent them from doing that same thing. There's going to be a defined business piece, right? So you can't prevent, if they're a programmer, you can't say you can't program anyplace else. You're going to say you can't work on my particular type of software servicing those types of clients. You can't prevent somebody from earning a living for themselves in their chosen profession. And the third thing is the duration of time. So how long can that non-compete last? Usually not more than 2 years, but there's flexibility there. And so again, thinking through those types of parameters will help you come up with a non-compete that is enforceable if that's something that you decide you want to do. Non-solicitation is kind of a corollary idea, which is basically if you're selling to my company, my clients now, you can't take that client list and immediately start selling to those same people. Or the other type of non-solicitation is for employees. So you decide, that's it, I've had it, I'm leaving this particular company. I'm going to go out and start my own company. It's not doing the same thing, but you can't pull those employees that were working with you into your new endeavor, because that also harms the company, right? If all of a sudden 15 people of your team of 30 leave, guess what? The company's not going to be able to execute as well. So there are lots of different ways to protect you and the company's interests. These are a couple of the flavors that we see most commonly. But again, it's trying to make sure that you're walking the fine line of protecting the particular business that you're starting from being competed against, or have really big assets, important assets of the company taken from the company, that would hinder the company's ability to continue to do its business. Let's see. What happens when somebody is no longer contributing, right? Let's say you're going in as 3 co-founders, right? One of you gets hit by a bus. Nobody really wants to talk about that, right? But it's a serious consideration. What happens if somebody wins the lottery and they're like, woo, I'm going to the beach, right? Oh, see you later. I'm going to have martinis on the beach. I'm going to buy my own private island. See you guys later. Good luck keeping that business going. And by the way, I'm going to keep my share when I go to the beach, right? So everybody else is continuing to work. And that person is not only seeing the increase in the growth of that equity, but also not contributing anymore, right? On the flip side, maybe it's somebody that it's not just not working out, but they're doing things to damage the company, right? They're embezzling from the company. They are, they're doing something else, right? They're creating client lists and then they're sending them to a competitor, right? Those types of things can be really troubling as well. And so what you want to do is basically create a framework that allows you to incentivize people, but you don't want to give them all their equity on day one. You probably, you personally may want to have your equity on day one, but you want to make sure that you're setting up a system where everybody is benefiting and the company is benefiting, right? And so usually what is the case 99% of the time, you're creating a new company, you're setting that up, everybody is subject to vesting. Vesting is basically the idea that you can vote all your equity from day one. If it's 4 partners and they're all split, 25%, or you have some other kind of arrangement, right? You can vote as though you have that 25% on day one, but actually if you leave, if you're going to do a vesting agreement, it's usually going to be a period of years. So for example, average time for a VC to return on their investment is about 7 years. Usually it's a couple of years before you can raise investment, right? So you should think of this as, potentially a 10-year long project. You're not going to want to have the vesting agreement that long, but 3 to 5 years is pretty normal for that type of period. And so basically people are going to earn it in equal increments over time as a way to incentivize everybody to stay in the company long enough to have created value in the company, right? If you've been in the company for 5 years, you've earned all your equity, and then you win the lottery and you're going to go off to the beach, right? Maybe that's perfectly okay, right? Maybe that's part of the agreement. Maybe other people now get more equity for staying, right? Maybe something else happens, right? But you've got a system that's been there. The business is still in business after 5 years. You're probably doing something right? You're probably not just sitting there pulling money out all the time and it's an abysmal failure, or you would have called it quits, right? So it creates an incentive that allows everybody to stay in the company for a long period of time, usually long enough to get investment. And if you're thinking about it a longer period of time, right, investors aren't going to invest in somebody that they think the CEO is going to immediately go out the back door, right? So usually investors are going to come in and they're going to enforce vesting agreements if you don't already have them in place. So if you've already picked your terms and you're down that pathway, you can sometimes preempt that and kind of get slightly ahead in terms of choosing your own vesting terms, right? Other things that, Broderick asked basically, how do you measure performance for vesting someone? I think for most people, it's easiest to just say, are you in or are you out, right? If you're no longer contributing, you're no longer an active member of the team, you got to fire that person, you got to let them go. That's when vesting stops, right? I've seen a lot of complicated ways to try to rebalance vesting on a regular basis or rebalance equity based on contributions. I think philosophically, those are really good things to think about and to engage with. But from a practical perspective, you're running the business, right? You're not going to sit down every month and think, okay, let me look at my time card and the things that I got done on my checklist, and now we're going to go into a weighted formula to figure out what was related to sales and what was related to development, what was related to manufacturing and operations and onboarding people. And then we're going to use this formula and we're going to figure out how much equity each person owned over the last month. And then we're going to do that every month, right? It's going to take hours of time. And from a practical perspective, in my experience, nobody has that time. Nobody takes that time. So I think there can be some really valuable things to think through in terms of rebalancing and refiguring things out. But I think from a practical perspective, you want to just it's easiest to go into a time-based vesting right off the bat. There are other flavors of vesting as well. So the most common other one is called milestone-based vesting. In other words, you get the specific things done that you need to get done, and that then a specific tranche of equity vests, right? Again, I think from a philosophical perspective, that makes a fair amount of sense. And it kind of aligns, but when you're an early founder of a brand new company, honestly, the things that you're doing on a day-to-day basis, you have no idea about, let alone what's going to happen in 5 years, right? Your product could change, your market could change. You start off as consumer, you start selling to businesses, right? You say, okay, as soon as we get our first sales, right, we'll go down that pathway. The problem is, when is your first sale, right? If you do a Kickstarter, is it when you get your first, bidder? Is it when you deliver your first product? Is it when you take in the first dollar? Is it when you deliver the product and it gets through the warranty period? Is it, what does it mean to get a sale, right? Everybody has to agree on what it is that they're doing and when that counts. And so you have to really, really nail that down right off the bat. And it's really difficult to do that. It's a lot more difficult, I think, than people think, because again, everybody's incentives aren't aligned, right? If it's your equity, you think it vested as soon as you got that first person clicked buy now on the website. If you're, somebody else, you might say, whoa, I mean, we had 50% returns last month. That doesn't really count, right? And so you got to think about those things. I gotten a couple of questions about service mark versus trademark, so I'm going to just post a link in the chat that I hope will help with that, rather than going down that rabbit hole a little bit more. But again, happy to chat about this stuff offline. Again, I will reiterate, I am not an intellectual property attorney, so it's something that you should think about when you're setting that stuff up. But I am not an expert in service mark versus trademark, or the specifics of what your patent might look like. So not the right person for that. Again, happy to chat or to help out further as you see fit, right? So again, what's our solution to incentivizing people? You're going to set up a vesting agreement. You're usually going to earn equity over time versus a milestone agreement, at least until you're far enough down the pathway to know what exactly it is that you're doing and what those things are. There are ways that you can set up what's called a hybrid agreement, which would be some time-based vesting, some hybrid vesting. But again, until you're far enough along to know what it is that you're going to do, know what your product specifically is, and be right about it with a high degree of certainty, I have a hard time recommending milestone-based vesting. Again, if you say they've got to make 10 sales and you start off as a consumer product and then you switch to a corporate thing, right? Those two sales mean very, very different things. And so you got to nail that stuff down a little bit more. Once you have all of that equity and you've divided things up, or you've got new people that come in that you're compensating with equity, right? So you might have the original founders. You're also, you have somebody else that's going to come in and be that first employee. You might also compensate them with equity, right? And so you got to keep track of all that stuff. Who has what? What does that mean? What are the vesting terms? You want to have that all in a centralized location. And it can get pretty complex pretty fast. If you don't get in the practice of doing this from day one, it's so much harder to catch back up later, right? And cap tables and exactly who has what is one of the things that I see people getting caught up in, having difficulty with in diligence processes with investors all the time, right? So you got to have everything in place. You got to keep track of it. Something else that I hear a lot, right, is, okay, we have a corporation, we've got 4 people, we've got 20 100 shares, and so each founder has 25 shares, right? We bring somebody else in, and they're going to get, let's say, 20% of the company, right? So everybody else is going from 25% to 20%. And they, I think the initial logical inclination is that everybody's going to give 5 shares to this new person so that you still have 100 shares. That is not the way that it works, right? You're going to create 20 new shares that are going to, or 25 new shares rather, that are going to go to that person. So you're always giving out new equity. You're not reallocating equity. Why do you do that? One, it's a lot of paperwork that nobody wants to do, right? Then everybody has to sign their own piece of paper saying, I give back 5 shares. And then you have to have a new agreement once all those are signed that says that this person's getting the 20 shares. So it slows everything down. There are also a lot of securities law implications. And so you don't want to get in trouble with the SEC. Not that they're looking into all these agreements, right? But again, if something goes wrong and you get into that situation, you can get yourself in additional trouble beyond the primary lawsuit with the SEC, and they can create additional problems for you. That is just not fun. Yeah, Emily, thank you for posting the IP and patent agent office hours. They would be great people to chat with one-on-one about service mark, trademark, or any other kind of IP issues or questions that you have. Dilution, yes. So dilution is not a dirty word. I'll let that sink in for a little bit. Like, I think a lot of people, they think of, I think that the most common thing that people thought of at least a few years ago was Facebook, right? And so there's this scene where they're getting that first big investor, they're converting their Delaware LLC to a Delaware corporation, and they created a bajillion shares, and Eduardo Severin got like none of them, right? So he got totally diluted out, right? They got sued for that, rightfully so, and lost, and had to cut a check to Eduardo. And I think Mark Zuckerberg publicly said that that was a bad idea later on. Contrast that maybe with the Winklevoss twins, right? That said that they came up with the original idea and Mark Zuckerberg stole it from them. I think that's a slightly different use case. But generally what's going to happen, right, is you're getting diluted. Well, you're getting diluted because somebody else is coming in and adding value, right? If you didn't think they were going to come in and add value, why are you bringing them into your team, right? And so it's compensating people that are going to come in and make the whole pie bigger. You're going to have a smaller piece of a larger pie, right? And I think that's a really important mental model to think up, right? And so, dilution, grow the pie, right? Would you rather have 50% of 5 million or 100% of 0, right? I think a lot of people think, I want to have all of this. I need to be, the sole person involved with this. I think particularly when you're dealing with scalable startups, particularly when you're dealing with tech startups, there's an expectation, because you're paying below market rates as a startup that doesn't have a lot of cash, that they're going to make up for it in the back end by earning that equity. And that's a perfectly valuable and viable way to go about that. And again, it just incentivizes people a heck of a lot more to pull that little bit harder, because there's not just the cash payment that they get their payroll check and they're done, right? They've gotten that money. There's the additional carrot that says, if you stay through your vesting period, not only can you get that equity over time, but when you start, the equity is worth, let's say, $1 a share. By the end, you want that value to be $10 a share or $20 a share or $100 a share, right? And so you want to create and contribute to that particular value of the company. Again, if you think nobody's bringing anything to the table, don't invite them in, right? They shouldn't be a part of your company, right? It's got to be a two-way street, and you have to make sure that they can actually do that in a reasonable way. Counter example to that would be, I forget her name off the top of my head, but the founder of Spanx is a billionaire, owns 100% of that company, right? So she was incredibly tenacious. Sarah Blakely, I think is her name. Yeah. So Sarah Blakely was literally a door-to-door fax salesperson. I'm going to say that again. She was a door-to-door fax machine salesperson. When she was walking around the South, she wanted to have a way to not have underwear lines under her white jeans in the hot South summers when she was selling things door to door. And she spent the next 3 or 4 years trying to get any pantyhose manufacturer to make a run of pantyhose just without feet, That's all she wanted, pantyhose without feet. And you know what? She flies around the country now in her private jet. She owns 100% of that thing. But I think that's a more atypical case in our current time, particularly with startups, right? Yeah, thanks for sharing that link. I think it's a super inspirational story. And again, no venture capital raised, pure hustle, right? Nobody hustled harder than Sarah Blakely going into factories dealing with you know, proper Southern men for 3 years on lunch breaks to try to get them to do a run of pantyhose without feet, and convincing people to write patents for her without paying for them. So yeah, Broderick, I think this covers some of the dilution things. Voting versus non-voting from the start, right? So again, going back to our S Corp example, right? You want to be able to at least have the flexibility of having multiple classes of stock. In S Corporation, you're limited to one, right? So as soon as you get an investor, usually they're going to ask for a preferred or other things, right? There are lots of other things that you can do to help compensate people. So one of those might be different voting rights for different people, right? Again, investors are going to ask for specific voting rights. Then you might have common shares, you might have options, you might have warrants, you might have profits interests, you could have non-voting shares, right? I think if you're thinking about it from a practical perspective in terms of who's going to be voting, one, if you're the founder, or the founding team, you're going to have a super majority of that voting stock for a really long time. Full stop, right? So are they really going to be able to outvote you on any given thing? Probably not, right? So when would that matter? Well, at some point you're going to, you know, you're taking in an investor. The investor is creating, usually as a part of that deal, some type of equity pool that you'll use to compensate new people that come into the team to make sure that they're also incentivized with equity over time. And so, you know, usually you're looking at an early stage funding deal, you're probably trying to sell somewhere between 10% on the low end and a third of the company on the high end of the company as a part of that round. It could be a couple of different forms, so that's generally kind of what you're looking at as a point of negotiation. And so you're going through that process. Well, guess what? Your employees are probably a lot more incentivized to vote with you in those instances that are going to come up down the line than the investors, right? Their incentives tend to be a lot more aligned with you. So can you do non-voting shares? Yes, absolutely. Does it make sense? Maybe, but I think if you think about it on a longer term basis, the key things that are going to come up where there's actually going to be a vote for the shareholders, those employees are much more likely to be aligned with you as the founder than they are with the investor. So sometimes I think that's something that people sleep on a little bit rather than kind of thinking through the full range of what that might look like later on. So is it possible? Absolutely. Does it make sense? Only you can make that decision for your particular company. All right. So quick summary. Legal entity is what you're going to form. It's going to be an LLC or a corporation probably, and corporation alludes here to a B corporation, a benefit corporation, or a C corporation, which is a classic corporation. You're going to create the agreements for that particular company. If it's an LLC, it's going to be an operating agreement. In a corporation, it's going to be a shareholders agreement or a stock agreement. You're going to want to have a founders agreement. That founders agreement should have a few different things in it. It should have some kind of arrangement for what you're getting paid or how you're getting paid or how you're being compensated. That should include your equity, which should be vesting over time. And it should also include IP assignment to get all the IP related to the company into the company. It may or may not include additional protective covenants or things like non-compete agreements, like non-solicitation agreements. And if you're, you know, there are a lot of tools out there now that can help you go through this process for a really reasonable price, right? Particularly if you're in Delaware, right, you can use tools, and I'll post some of these in the chat. Founders Workbench, free legal documents that'll do all of these things for you. Cooley Go. Cooley is a giant law firm. They're one of the top 3 venture capital practices in the country. They actually share an office in the incubator where they provide office hours when we're not in a pandemic and actually existing in person. But they have a free resource on their website, Cooley Go, that allow you to print out a lot of these documents for free. There are a lot of other document generators as well. Clerky has some that are low cost, but pretty easy to map. And they'll handle the incorporation with you as well. So there are lots of ways to do this in a relatively reasonable way and get yourself, your co-founders, and the company protected. If it gets on down the line later on, you can always go back and have these things rewritten or redrafted, assuming that everybody agrees or is mostly in agreement with those things. But if you need to get something in place, you can create a legal entity the same day, right? If you're filing in Delaware, you file. It's past business hours now, so if I went on their website and filed, it probably wouldn't get on their website till tomorrow. But you'd have an entity probably about 9:15 tomorrow morning, right? So it's a really fast process to do that. So it's not something where you need to be like, well, I could have something to do with it in 3 months. No, then wait, 2 months and 30 days or 2 months and 29 days before you file that, depending on the month. Maybe it could be as few as 27. But you can do those things pretty much instantaneously and get them set up in a reasonable way. So it's really, the calculus is, when am I aggregating those assets or those liabilities? When am I signing contracts? When am I doing other things? Okay, now it's time to go and do that. How can I get this set up in a reasonable way? And you can use those websites, perfectly valid, will you get you set up in a really professional way. But if you're going to go out and interview attorneys, you should make sure that they know what it is to be a startup attorney. If they're a big time M&A attorney, it really may, it really may not be the right attorney for you, right? They may not know what a vesting agreement is. They might know what an earnout agreement is. They might not have protect, CEOs with golden parachutes. That is not the droid you are looking for, right? You need somebody that really understands startups and knows what that means. And so 83B agreement is a great example of that. Getting into the weeds here for just a minute, right? So when you earn equity over time, as far as the IRS is concerned, it's not taxable as an asset until it is yours for keeps. And that means when it vests, right? So if you can vote it, but it's not yours because the company can terminate your vesting agreement by firing you, then it's not yours until you vest, right? So if you get a 5-year, or let's go easier, rounder numbers, right? Let's say you're going to have 1 million shares, they're vesting over 4 years. It's at the end of year 1. You've got 25% of that, or 250,000 shares, right? When that becomes yours for keep at the 1-year anniversary, then it is a taxable event. Well, guess what? If you went out and raised a couple $1 million in that period, the value of that equity is now substantial. The IRS is going to say, you just earned the equivalent of a few $100,000. We are going to tax you as though somebody handed you a check for that. Well, guess what? That's a really bad result. I don't know about you. I don't have the money to pay the taxes on that, right? And so the way that you solve that problem is you file an 83B election. The 83B election, you have 30 days only to file that 83B election with the IRS wherever you file your taxes. It's a pretty straightforward 1-sheet form. And basically what it says is, IRS, I understand this equity is not mine for keeps. I just created this entity though. The tax value of this entity is 0 or pretty close to 0. And so I'm going to prepay my taxes as though I have all of that equity, right? So your tax liability is what the equity is worth minus what you paid for it. If you don't have a product, if you don't have sales, if you don't have a code base or designs or anything else from a practical perspective, that legal entity is probably worth 0 from a tax perspective, right? And so you're going to prepay your taxes. That means writing the IRS a check of $0, and you will owe $0 on all of that equity. Critically important thing. It is a key thing that trips people up all the time. So if you talk to an attorney and you're like, yeah, I'd really like to have a vesting agreement. And they're like, oh, yeah, cool. That sounds great. And you're like, will you help me with my 83B election? And they look like you just walked off of a UFO, right? Run. They are not the right attorney for this particular job, right? They might be a great patent attorney. They might be great when you're going public. They might be great if you're getting sued by somebody, right? But they're not a startup attorney. And so you can use that as kind of a way to figure out, is this the right person that can really help me at this phase or not? Again, you go through something like Founders Workbench, it'll print out the 83B election and ask you the right questions at the right time. When you do that, then you just have to nail it in, right? So this is a lot to consider. Whoa. So I'm going to unshare my screen here, and we can go back. These are a lot of really complex questions and topics. So I just want to open it up quickly. I see a lot of people have gone off cameras as they fall asleep softly to the sounds of legal presentations. So who's got a hypothetical question? Benjamin, no, the LLC would not need to be set up as a corporation to avoid tax on increased equity. So you can set up a vesting agreement with either an LLC or a corporation. It's exactly the same. You're still going to file an 83B election. You're going to send it to the IRS. It's going to be exactly the same calculation, which is what did I pay for it? What's it worth? Possibly zero for both. And then you'd go further. Sorry, Jacqueline or Jaqueen, you had your hand up.
Yes, hi, thank you. Enjoyed the talk, a lot of information. I just have a quick question because I have an LLC in Delaware. It was established back in 2015, but because I didn't know how to use it because I live in PA, I was just about to dissolve it. So you spoke a lot about being able to use it. So what do I do with this LLC? Because I just opened up another one in PA because I was under the impression when I initially opened that one that I could just use it, but then I learned that I couldn't. So what am I?
Oh, you can. So I think there are a couple of questions there, right?
Okay.
First is, you have a Delaware LLC. Can you use it in Pennsylvania?
Yes.
Absolutely. You can absolutely use it in Pennsylvania. Once you start doing business in Pennsylvania, right? You're signing contracts, you're taking in revenue, you're doing other things, right? You have to file as what's called a foreign entity doing business in Pennsylvania. Again, it's just another one-sheet form that you'd print out off the website for Pennsylvania Department of Corporations. And then you'd register, and again, you'd just be paying an additional kind of couple $100 fee to the state of Pennsylvania, in addition to your registered agent and your normal annual fee for Delaware. So it's adding a couple $100 to that fee, but that's the way you do it. It's perfectly fine. Also, if you're just like, you want to start from scratch, you can just wind it up and you can start a new Pennsylvania LLC. That's totally fine. Also, if you have something that's ongoing, you've got an ongoing business, you just want to make sure that you're being clear that you're starting a new entity. You want to try to make sure, again, there's an IP assignment agreement to pull that stuff over. You could theoretically do basically a merger or an acquisition with a new PA LLC. This is all getting way too complicated, right? And so, again, if you want to think through that a little bit more, happy to chat further. But the answer is yes, you can use your Delaware LLC. Yes, you can also create a new Pennsylvania LLC, but don't have a whole bunch of LLCs that are just sitting around not doing anything, because that's just money out of your pocket, right? Nobody wants that.
Okay, and I just have one follow-up question, because initially I was going to do that and just do the foreign one, but then someone stated, well, you're going to be paying double taxes. You still have to pay your franchise tax in Delaware, and then you're going to have to pay taxes to PA, and you're going to need accountings in both states to do it. So it's not, I don't have a big business. They said if I was a huge corporation, it would make sense. And that's why, the person that did it in Delaware, they were thinking kind of big, but your business is small. So they told me that PA would probably be better because I am kind of a small business.
Yeah. So let me ask you a different question. Ultimately, if this thing is successful, where are you going to be based? Are you going to be just in, Philadelphia, for example, or just in Pennsylvania? Is this, something going to be through the Mid-Atlantic? Is it something that would be throughout the country? Is it something that would be international? Are you going to the moon? Like, where are you looking to go? What's your plan?
I would just be in the US, and I do plan to start selling things online. So I will be doing things national, but for right now, I'm kind of just in the Philadelphia area, the suburbs, tri-state. That's kind of the extent of where I am right now.
Okay. Are you looking to raise capital? Like, are you looking to get angel investors? Are you looking to get venture investors? Are you looking to do other things like that?
Probably not for at least 5 years, like when I open up a brick and mortar, because right now, I'm just in the home based, everything is going out. But in 5 years, I am planning to open up a preschool. So it's going to actually be a school and a daycare. So then I will need investors for that, because I'm going to need more money. But for right now,
of course.
It's just me. I can afford everything. That's what I've been working with. But in 5 years, I'm going to need some investors.
Right. And so You know, I think if you're thinking about running something that is more of a small business, maybe you're going to have a couple of people, but it's really going to be based out of physical operations in this region, it may honestly not be worth the couple, you know, the extra $300, $400, $500 to have a Delaware LLC, right? And so that's a calculation that you have to make. You know, do you want the better insurance policy that might get things resolved quicker, but you got to pay for it, or would you rather just have like, look, I want to keep as much money in my pocket as possible, and then you just form the Pennsylvania LLC and you kind of wind up and let that Delaware LLC expire. Probably, right? There are exceptions to this, and I don't want to get into all of the weeds on all the things that could potentially go wrong, but that doesn't make no sense to me. The other thing to keep in mind is you really like double taxation. There really isn't a thing, right? So when I think of taxation, right, I think of income, I think of revenue, I think of other things, right? For Delaware LLC, it's going to be that flat fee on an annual basis, but they're not going to be taking additional revenue or proceeds or things like that. Really, you're just going to be basically paying those annual filing fees. So you're going to pay for the revenue and the taxes wherever that equity is owned in, or the revenue is owned in the state where it's owned, or more accurately, where you declare that revenue. So if you declare that revenue as being made in Delaware, you could do that, right? There might be tax reasons to do that, but an accountant can help you do that. And usually one accountant is sufficient to help you do that. You're not going to need Delaware accountant, Pennsylvania accountant, you know, Philadelphia County accountant, Montgomery County accountant, right? You're going to have one person that's going to help you handle all that stuff.
Okay, thank you so much. I appreciate your help. Oh, I'm sorry.
You're welcome.
One more quick question. So if I only wanted to sell items online, could I use the Delaware LLC if I didn't have like a physical location? Because someone was saying now they've changed it with the Nexus or something, that if I have a server in PA and I'm using that server, that I can't technically just only say I'm online and use the Delaware LLC.
Well, again, you can use the Delaware LLC, but if you're making sales, you're going to have to declare those sales in the place probably where you're doing it from, right? And so you're gonna have, if you're based in PA, you're going to have PA income because you're going to pay yourself. And so you're going to have to figure out that particular arrangement. But again, a good accountant that deals with small businesses can sit down and help you do that pretty easily. And I'm sure Tom has oodles of great accountants that he can help set you up with. Or again, happy to continue to chat about these specifics kind of offline.
Okay, thank you so much. Have a good one.
Yeah, thank you,
everybody.
Eamon, one of the requests that we have in the chat is your contact information. So please add that.
I put my email addresses in the chat, so you can drop me a line. We can always set up time to chat. I generally do office hours through Drexel on Wednesdays from 11 to noon. So that's a free drop-in type office hours, and I can drop that link in the chat if people are interested in that as well. I can also send out a copy of the presentation if that's helpful for anybody that wants to review it, you know, through Venture Cafe's many technologies. What else? Yeah. I can't believe I answered everybody's questions about legal.
Eamon, I had a quick question for you. I think you said this, but I want to make sure I heard correctly. Is it typical if you have an existing LLC and you're going to take on do a first round of investors to do the C Corp conversion at the time of the close, so you don't have to do it in advance, or do you have to do it in advance before the term sheet?
No, you don't have to do it before the term sheet. Usually, it technically has to happen before the investment, but from a practical perspective, that's a second before the investment, right? And so usually those costs will be absorbed into the particular transaction costs. The documents will have legal fees already outlined, and you're going to be surprised. Attorneys always come in exactly at the legal limit for whatever is carved out in that particular transaction. So if it's $25K, guess what? It's going to cost $25K. It doesn't matter whether you're converting from an LLC to a corporation or not. It's going to be the same. The other thing to kind of bear in mind is, again, don't pay for that conversion until you have to, right? So if it can just get lumped into that, why pay the few $1,000s or whatever to draft new documents and all that stuff? Like, just punt until it needs to happen. But embedded in that question, right, is what form or what entity do you need to be if you're raising a venture capital round, right? And so I think a lot of people think they're going to go out and they're going to raise millions of dollars of venture capital, month 2, and they're going to fund the build out of this product and this idea and this company, right? That's usually not how it happens. And so usually people will get friends and family dollars, and then they'll get kind of angel investors, and then they'll kind of work up to venture rounds. Venture firms cannot invest directly into pass-through entities for legal reasons, right? And I think this is something that a lot of people don't really know, which is how did venture capital, like what is venture capital? What does it do? It's a bunch of people investing other people's money, not their own money, right? That's what venture capital is. And where does that money come from? Well, that money comes from insurance companies that are sitting on all those premiums that are looking to make a return. It comes from pension funds, right? The biggest venture capital investors in the country are pension funds for California, for Pennsylvania, for New York, right? Could be state employees, could be teachers, unions, could be other things, right? Those are the biggest people investing in these firms. Well, guess what? If you're running the fund for the taxi cab union and you invest in a venture capital fund and that venture capital fund invests in Uber, how's that going to go? Not great, right? There are a lot of different liabilities involved there potentially. And so there need to be hard breaks in liability between venture capital firms and the companies that they invest in, and between venture capital firms and the people that invest in them, right? And so if you're an LLC, if you're a pass-through, they could potentially set up a blocker corporation. There's a lot of data that suggests that even though that's only a few $100s a year, it really adds up over the course of an investment cycle, which is usually 10 years for a venture capitalist for a given firm. And so they don't want to be spending tens of thousands of dollars on that type of thing. And so they force people to convert to corporations so that they don't have to deal with any of those bleed through issues. Good question.
Very clear. Good answer. Very clear. Other questions? Can you also share, even go back over for people so they understand the real opportunity behind dilution, and that it is not something to be afraid of?
Yeah,
because I've seen that a number of times.
Yeah, well, I think for a lot of people, right, and understandably so, right? You're a solo founder or a founding team, right? This is your baby, right? This is your baby. This is, you're gonna quit your job. You're gonna, or create a side hustle. You're gonna do this. You want this to be the future of what you're doing, right? And so, understandably, there's a lot of reticence to let other people into that, to share in that, right? It's your idea. It's this thing that you've been thinking about for decades, and now there's this other person that comes in, and you're just hiring them to do a job, right? But this is something you've been thinking about for a decade, right? I think if it's somebody that you trust enough to bring in as a part of your team, if it's somebody that you trust enough to pay a salary, or particularly a first salary, right? The first person that's getting money out of this, right? You want them to be able to think long-term about this product. You want them to be as invested in it as you. So that doesn't mean you're going to cut them in at the same amount that you are, right? But they should share in the upside when this thing is wildly successful. And the easiest way to get people to buy in and get incentivized to contribute with a long-term lens is to incentivize them with equity. And so, I think if you're thinking about a growth startup, if you're thinking about something that's going to go out and raise capital, right, you're already thinking about giving up some of the equity, because guess what? No venture capital company is getting in without equity, right? They're going to buy that equity. That's what they want. If you do the math on a successful exit, right, guess what? All those investors that are like, yeah, I got in an Airbnb, I got 1,000x. Can you imagine taking out a loan at 1,000x, 1,000%, right? That is crazy, right? So venture capital is the most expensive money you can possibly imagine. Full stop, right? Comes with all kinds of strings, right? It is not an achievement to raise venture capital. It is a tool to meet very specific goals, which are to go from 0 to $1 billion in a decade. That's why you raise venture capital. If you're not looking at it on that scale, if you're not thinking about it on that scale, then you should be talking to other people, right? That's when venture capitalists make their money. That's what they want to see. So going back to think about that, right? You don't want that person coming in and building that first product, doing all this hard work, and then walking out that door, right? You can't afford it, right? You need them to stick around. The way to get them to stick around is to incentivize them with equity where they gain when the company gains. And I think that's such a difficult thing for so many people to think about, because they think about control. They think about, you know, you don't want to give up a couple of fingers off of your baby to some other person that you don't really know, right? But you got to think about how this is going to be successful over 5 or 10 years, and getting them bought in and committed as you are, close to as committed as you can be to this company. And so you want a smaller piece of a bigger pie, right? You want that pie to be a heck of a lot more valuable. The way you get that to be more valuable is you get people into your team that are doing great, phenomenal, fantastic things that evolve and develop and iterate this particular company. And so, yeah, it should be a badge of honor to give up some equity to other people that are going to go on this journey with you.
Excellent response. Excellent response. So before we wrap up for this evening's workshop, are there any more questions for Eamon?
I have one question.
Please do.
It's
And your name is?
My name is Hugh Ann.
Hugh Ann. Thank you, Hugh Ann.
Yeah, thank you.
Yes, I just had a question about equity. So let's say you make money off of your venture. When you give out equity, it comes off the top to the investors?
So equity is like a share price of a publicly traded company, right? That's equity, right? If you go on and you buy a share of Google or you buy a share of Amazon, that is a piece of equity in that company. So why do you buy that equity, right? You buy that equity because you think that Amazon is worth whatever it's worth today and it's going to be worth more tomorrow, right? And so it's, when are you going to get paid by Amazon? Possibly never, right? I don't think they have any dividends, right? But theoretically, those people that own equity or shares, we get paid when they're dividends, or they get paid when they sell the equity, right? And they gather the increase in the value of that share price over time. So when you're paying money, right, there are a lot of different ways to pay money in any given company. And again, a good accountant will help you set this up. But there's kind of salaries come out first, right? So, you know, people that you're paying a salary to, including maybe you, those people are going to get paid first. At the end of the year, there might be profits or losses. Those profits or losses might stay in the company, or they might get distributed, right? And so if you have profit that gets distributed, that's usually a dividend. And that's, I think, what you're thinking about, which is, you know, who gets this money at the end of the year, right? It's basically looking at a profit, deciding not that the profit isn't going to roll over into the next year, but you're going to send it out to the people who are shareholders. Then they might get money.
Yeah, and also too, as you were just explaining, I mean, that's a management decision. I think the other part of the question that some people may be thinking about, Eamon, and you could touch on a little bit, was when you talk about exiting. So you have the opportunity, you've taken in investors, you are a founder, you have co-founders, you raise capital, now you're looking at an exit. And I know we're running out of time, but, you know, talk about you quickly, the types of exits and why people do exit.
Yeah, so the primary reason that people exit is they want to do something else, right? Usually for founders, they have some other great idea that doesn't fit smoothly into that particular company. And so they're going to go out and commit to doing something new. Those timelines and incentives change drastically when you're raising venture capital, right? So venture capital is a very weird animal, right? Venture capitalist raises a fund, let's say that's $50 million, right? Their job is to invest that $50 million and get it back, ideally at 10x. That's what they're going to target, 10x. So they're going to invest $50 million. In 10 years, they want $500 million. That's what they're looking to do. The way that they get their money out is an exit. So that exit is usually, traditionally that's thought of as IPO or taking that company public. For a lot of reasons, that's been a little bit of a downtrend. So the next ideal is to get acquired by something else, right? And so you're creating a tech company, you're going to get bought by Google. You're creating a product company, you're going to get bought by, I don't know, maybe Walmart, right? Maybe some other big product company, depending on the specific target, right? Some other area that you're interested in. And so the venture capitalist needs to get their money out. They're going to push and push and push for them to find a way to get their money out. And the most common way to do that is to get you to sell your business, either through the public markets or through to another company. And so that's kind of the exit. And then when you get that exit, right, it could be in cash, it could be in other stock, right? Maybe you're going to get bought by Google, and Google is going to give you shares of stock in exchange for your stock in your company, right? And so then you have Google stock, right? That has a cash value attached to it. But there are a lot of different ways to do that, and that's usually what investors are going to push for, is some way to get their money back.
Yeah.
Does that help answer the question?
Also, too, as well as the founder, I mean, you don't walk away with nothing. If there's a valuation based on that and it's 10x in terms of what you put into it, that you as a founder walk away at that time also too with your return on investment. There's a couple questions that jumped into the chat. Looks like a basic thank you to Eamon. Eamon, thank you very much. Before we move into Startup Roundtable, everybody, this has been another great workshop tonight. A lot of great information by our facilitator, Eamon Gallagher. Everything from equity to operating agreements to IP was covered. Hopefully there was something in there for each of you that you were able to take away a little nugget. Eamon did post his information. I highly recommend you reach out and follow up if you have any real legal questions. He's a great resource. I use him and refer people to him all the time. But with that, wrapping up, is it Angela? Is Emily, Angela, are we both on? Can we get the poll results for tonight?
Yes.
Oh, yeah.
Okay. What do we have? Over the next 12 months, we're looking at basically, raising capital and product development are the top priorities for most of the people tonight. Followed by sales growth, expanding to new markets, and then other. So it is now 6 o'clock. I want to thank everybody again. We're going to see you next week. And at this time, Eamon, I'm turning back over to you. I'm assuming Aaron is on now.
Oh yeah, I'm lurking.
Always, my friend.
Always.
And thank everyone again tonight for another great workshop. Now we can go into Startup Roundtable.